Lucas, we have a special guest with us today. Who's our guest?
Our guest is Caden. Caden is from our CPA firm that we use
Personally, yeah, for our businesses.
Called Beck. B-E-C is how you spell it, not B-E-C-K. Don't look that up. But these guys have helped us tremendously. I've spent a lot of time on the phone and on Zoom calls with Caden, and these guys are dialed in, and that's why Sam and I had an episode about 2 or 3 episodes ago of us trying to explain the big, beautiful bill.
Before it passed, and we didn't know that it hadn't passed yet. But
yeah,
yes.
And we just didn't do it justice. So Caden reached out. He's like, hey, guys, have you thought about this? So we're going to bring you guys the expert today.
Yeah, so we're going to talk about the one big, beautiful bill. And Luke and I are going to take it from the stance we really don't know much of what it's about. Caden has a lot prepared. So we're just kind of going to dig around and poke around and ask questions that we think are pertinent to what we're doing and what you guys are doing. So, Caden, would you mind just kind of introducing yourself to the audience and kind of talking about what you do in your experience?
Yeah, absolutely. I'm a CPA. I'm an enrolled agent. I've been in the tax game here for about 5 years now. Really enjoy working with real estate entrepreneurs and investors. Help put together some really great tax plans for people and help them drive their wealth by keeping more of what they earn. So it's kind of what we do at Beck. We've got accounting, CFO, and tax services that we work with clients on.
Awesome. I like it. And you guys are saved us a lot of money in taxes. So I'm just going to open up the floodgates a little bit. And I know some of this is you can't give legal advice or tax advice or whatever all those rules are. So we understand that's not this. But what is your personal favorite part of the big, beautiful bill?
Yeah, that's a really great question.
I know I'm a good question asker, Caden. I know I'm really good at this.
You are really good at this. So got to give you props. My favorite part is kind of taking a step back and looking at this holistically to see what kind of behavior the government's trying to incentivize. That's all tax law is. The government wants us to do certain things and they reward us for doing it, right? So yeah. I see a lot of the tax law changes. One, they're like you guys mentioned on your last podcast, Trump remembers who voted for him. He's giving back to the blue collar backbone of America with the overtime, the tips, all that good stuff. But then on top of that, this is something I don't think people think about, is there's opportunity zones. I know you guys talked about that as well. I see opportunity zones almost as like a government incentivized philanthropy-esque tax law. They want people to, rich people to take their money and invest in these places that maybe the test of time has taken its toll and the neighborhood could use a revamp. And there's a huge incentive for people to do that. So I thought that was kind of interesting.
Yeah, you said there's a huge incentive for people to do that. What does that incentive look like in this bill?
Yeah, the opportunity zone. So for those of you who don't really know what that is, back in 2017, Trump introduced opportunity zones into the play. Most people didn't take advantage of it because they were a little bit complicated, had to be digested. So really only the top players were able to execute on them fast enough to take benefits. Well, the second time around, these opportunity zones, which to kind of break down what that is, it's these low income areas that are labeled by the government. So there's a specific process they go and label these. If you put money into a qualified fund, qualified opportunity zone fund, and through that fund invest in these areas, you get to take advantage of capital gain deferral. So this is all about capital gain deferral. You need to be exiting an asset, a business, a piece of real estate, something like that, have capital gains. You take your gain, so let's say $1 million, you take your $1 million capital gain, put it into the fund, buy a new asset in an opportunity zone. You're going to get to defer $1 million of gain for 5 years under the new bill. And after holding the opportunity zone property, so that new asset you purchased for 5 years, you'll get a 10% discount on the gain that you recognized back 5 years ago that you didn't pay taxes on yet. So you're going to get a 10% discount. The bigger play is holding that opportunity zone property for 10 years. If you hold that opportunity zone property for 10 years, when you sell that property, you will not pay any taxes on the capital gains. You will not recapture any depreciation, and you get a tax-free exit after 10 years.
So that's incredible. So it's to me. So when you say opportunity zones and people putting money into this, it's, would you call it like the the bigger maybe apartment type syndicator operators? They're going to benefit because they can get new money from people who will see more tax benefits than they did before, and people that aren't the operators or maybe the LPs in the deal can see a direct benefit to themselves and their money and their return and everything that's included in there. Is that how you would slice it into the like real estate world that we're in?
Yeah, I think that hits the nail on the head. I think another play that I see, this is, I'm going to kind of piggyback on Opportunity Zone with another piece that's actually written in the bill. There's some special depreciation that was written into the bill for qualified production activities. That's a fancy way of saying domestic manufacturing. Okay. The bill wants to incentivize domestic manufacturing, and they're going to, let's break down maybe an example so I can kind of show you the power behind this. If you or a group of people go and purchase or build a new manufacturing plant where you're making widgets in the U.S. Widgets could be, steel, it could be computer chips, all kinds of different physical things that are being made. It could be plastic bottle caps. The sky's the limit there. This new tax bill has a code where you'll actually get to write off 100% of that new asset that's being placed in service. So you guys are familiar with cost segregation study and how the numbers kind of, you take your $1 million real estate, you take the cost segregation study and bucket it up, and then you get a percentage is what you're writing off. Well, this is actually saying no cost segregation study. You have $1 million manufacturing plant, you're writing off 100% of that manufacturing plant. Way more powerful accelerated depreciation than what we're typically dealing with. Now, putting that in the context of the opportunity zone, it's job creation. So the government wants us to make manufacturing in the U.S., have it, go through a revival. If we take the opportunity zone, get some wealthy people to invest in these in low-income areas, they're going to create jobs. And when they create jobs, it creates opportunity for folks in that area to rebuild the neighborhood themselves. These investors are going to hold on to this property, get massive write-offs for tax purposes, and then if they hold it for 10 years, they can get out of it tax-free with no recapture. Huge, huge opportunity with that. And to your point, Lucas, syndications, even private money, you don't have to have a syndication to make a qualified opportunity zone fund. You can actually just set up an LLC and get the right fancy paperwork behind that LLC to qualify.
Yeah. So it sounds like not only does he want to incentivize, because like you said, Caden, he's trying to, or his administration's trying to incentivize behaviors, and he wants more money to dump into opportunity zones, but he also, I guess, is incentivizing the length of ownership too. What Caden or Sam, why do you guys think he's incentivizing the length of ownership here?
Yeah, I would think if you're doing that, you want someone to actually put up roots there and own it long term and do it the right way rather than just try to flip it. If you're owning a rental somewhere, you're more likely to take care of it, maybe invest in other areas around that, and want the whole area to do better for a longer period of time rather than just come in, dump some money, and leave.
Sure.
That's my thought.
It's a very different strategy than trying to raise the value as quickly as possible and then selling it, right? So that's the first thing I thought of too. Caden, any thoughts there?
Yeah, I think you hit the nail on the head, Sam. I think, a vested interest for a longer period of time is more likely to lead to those outcomes where the neighborhood actually gets, better off for it, and it just builds up that infrastructure within the U.S.
I like it. So there's a lot of us we're going to get into. We're going to kind of comb through this thing. But as you were kind of talking about the, manufacturing and, I guess initially I was thinking syndication in apartments like Lucas, but it sounds like you can do that, through like a private funds. What are some of the things that most of our listeners would be able to benefit from? Probably leaning more towards like real estate investors, people that do a few flips a year, maybe own 10 rentals, and some entrepreneurs maybe that aren't in real estate. So kind of the smaller business, the solopreneur, small entrepreneur, investor. What are some of the things in this bill that stick out to you that would benefit them the most, that either is a complete change from what was there or just a re-emphasis of what was there?
Yeah, absolutely. So some backbone tax provisions that have kind of been extended. They were going to go away, but they're being extended, and they're benefiting everybody. We've got lower tax brackets. So the top tax bracket's 37%. It's staying 37%. It was going to revert back to 39.6. The brackets are wider, which means you climb them slower and pay less taxes. So it takes you a lot more money to pay the higher tax brackets. That's a really nice feature of the big, beautiful bill. The standard deduction, this is another thing that's really benefiting everybody, whether you're a solopreneur or not. You're getting an instant, if you're single, first $15,750 is not getting taxed by the government. Or if you're married, $31,500 is not getting taxed by the government. That's a gimme to everybody. Another great one for entrepreneurs is what's called the qualified business income deduction. Basically, ideally, qualified business income is just your business income, and you are operating it like a business, and it's not an excluded business. You're going to get a 20% discount on your business income. So let's say you are a small business, you make $200,000 of profit, you would get a $40,000 deduction given to you by the government as a benefit of this bill. So you're only going to pay tax on $160,000, even though you took home $200,000.
Yeah, those are three great ones right there. So just to put a little bit of color around that. So back in 2017, if you made $44,000 a year, you would be taxed at 25%, your tax rate. And now and moving forward, you would be taxed at 12%.
Yeah.
That's a big difference. It's not that big a difference every dollar amount. I picked that dollar amount because it is a big swing, but that's pretty cool right there. And on the increased standard deduction, like I remember working through this with you, Caden, but us as entrepreneurs, we have a lot of business write-offs, but it takes a ton of business type expenses and write-offs to overtake the standard deduction. A lot of times the standard deduction is just the easier way to go because it's so high right now, and you're going to get more benefit of that than to itemize everything on your tax return. Is that accurate to say?
Yeah. So the business deductions, those are kind of taken care of in a separate bucket. Where you're getting at with standard versus itemized, most people can't itemize their deductions because there's limitations before things kick in, like your medical costs. You have to have more than 7.5% of your income. Everything above that in medical costs is what you get. Most people aren't paying that much unless they've got a serious illness. And, hopefully that's not your case, but if it is, that might be something you can take advantage of.
Lucas is ill in the head, but not anything that we can actually substantiate, but keep going.
Exactly. You've got a cap on the amount of state and local taxes you're able to itemize. So you can only do up to 10,000. They, I guess to touch on that, they expanded that in this new bill, and it says the limit's now $40,000. But as soon as you hit about $500,000 to $600,000 of income, you get capped back at 10,000. So it's the same limit we've all had for the last 8 years. And the silly thing is, if you go and look at the state tax rates, most state tax rates are between 5 and 6%, and at 500,000 times 6%, that's only $30,000 of tax, and then you're getting capped anyway. So it's kind of silly, but not going to take advantage of that. Your mortgage interest is another thing there. Most people that I see maybe get up to like $18,000, $20,000 when they're married, where the standard deduction is going to exceed that by over $10,000.
Yeah. That makes sense. So wanted to dig in a little bit of like what's what people say is real and what's not real. So I hear this: no tax on tip, no tax on overtime. Looking at your notes, it looks like it's a deduction. Is it truly no tax on any amount of tips and no tax on any amount of overtime, or is there some limits there?
Yeah, so that is a little misleading. The promise was no tax on tips, no tax on overtime. What actually got delivered in the final draft of the bill is for people that make a certain amount of income or less. If you're single, it's 150,000. If you're married, it's 300,000 with your spouse. If you make less than those amounts on tips, you'll get a deduction of up to $25,000. So I was actually just sitting in an Olive Garden yesterday with my wife, and I was like, I wonder how much is this going to benefit the waiter that I have? So I got to ask him, like, how much do you get in tips and stuff? And he works there full time. He's maybe getting like, $24,000, $25,000 right there around in tips. But his take home pay is just above that because he gets some small hourly. It's not making that big a difference down at that level. Folks are already getting that standard deduction. So when you kind of look at it, maybe it's taking them home $1,000 to $1,500 extra a year. It's not that crazy a deal. The other side, overtime, this one maybe has a better play, but you get $12,500 if you're single, or $25,000 if you're a married couple, and you still have to be under those income thresholds. Maybe the price tag for somebody that's maybe around $100,000 to $150,000 of income that's married, they're maybe saving $5,000 to $6,000 off of that. So that's kind of where it comes into play.
Yeah. Something else that is on your notes, Caden, is there is a new retirement account, and of course, President Trump named it after himself and called it the Trump account.
In due fashion, right?
Yeah, in Trump, true Trump fashion for sure. But what this account is seems pretty cool to me. And do you mind telling the people what is this Trump account and how can it benefit us and our kids?
Yeah, the Trump account. So it's designed for kids that are being born and up to 18. So unfortunately, all of us that are over 18 can't use them. But the Trump account is almost like a quasi multi-purpose tax incentivized account. If you're familiar with the, like Roth IRA, a health savings account, an education savings account, and even expands into business startup usage, buying a first home. This account is really encompassing what I think the struggles of youth today are, that there's not just this one defined path where you go to college and then you get a job and then you do the rat race that everybody's been taught for the last 50 years. There's so much opportunity out there. So the kids are going to be able to get up to $5,000 in the account per year. For kids born between 2023 and 2028, the government as a pilot program is going to actually donate $1,000 into the account for you. And then there's some opportunities for parents, grandparents, cousins, neighbors, whoever, to put that money away for your kid as well, up to that $5,000 per kid per year limit.
Yeah, it's great because, like you said, there's really no one-stop shop for, there's some workarounds with creating wealth for our kids, but you got the 529 plan, right, which you talked about, which the majority of it has to be used for educational expenses anyway. I think just recently, not that long ago, you're now allowed to convert a certain dollar amount into a Roth if you don't use it for education. Is that accurate on the 529?
Yeah, it's up to $30,000, I think, per kid.
Which is cool, right? That's a step in the right direction. And then you got a Roth, right? Which for those, like your normal retirement account, you're going to pay taxes on some sort of something in there, right? With the Roth, you don't pay taxes on anything, I believe, Caden. You don't pay taxes on the gains or any of the distribution. Is that accurate?
That's right.
So, but our kids can't do a Roth because you have to have income to get inside of a Roth IRA. Is that accurate, Caden?
Yep.
So this to me is just an incredible, there's people who have been working around getting kids set up for Ross by paying them and stuff like that, which is amazing. But there's no workarounds for this. It's just right there. Hey, start creating generational wealth for your kid. Here's the account to do it, and I think that's super cool.
That's probably why I named it after himself, because it's maybe one of the more beneficial ones
Yeah.
for a lot of people.
Yeah, I was going to say, just before we transition off of that one, this bill is pretty young. This kind of goes without saying. It's just over a week old. That particular piece of the bill, I think, has a lot open to interpretation, and I'm going to be very interested to see what kind of strategies come up around the Trump accounts. At a surface level, it's covered those things, but there could be opportunity for some pretty massive generational wealth building through those accounts.
No doubt.
That stuff adds up, man. Think about starting an account when you're so I have a daughter going to be born in October. Start our account with her with $5,000 in there, and then just watch that thing grow. That could get wild quickly.
It could. I think. So that's a good point, Caden. Very, very new, right? So, say you have an E-Trade account or have a financial advisor, and you go to him or you go to E-Trade, like, I want to start a Trump account. Like, when's the soonest people can be able to do this, you think?
Yeah, so the kind of feel out there right now is they just passed the law. They're trying to figure out how to actually administer and do all the record keeping and get this out to the public. The expectation is probably within a year from now is when you'll actually be able to open your account and put money into it. Some of the language is a little bit vague in there about contribution limits too. This is what's kind of interesting. It specifically dictates up to $5,000 a year. And then it tells you who can do up to that $5,000. It even includes employers being able to put money into that, or putting it into dependents of employees' accounts. But then what kind of is interesting and is maybe going to be a loophole with this, which I wonder if they're going to close this up or not, is charities and private foundations are able to, it doesn't place a limit on them how much they're able to contribute into the accounts. It kind of gets your wheels turning about what the implications of that might be.
Yeah, that'd be wild.
It sure does.
Mm-hmm. Yeah, be able to give money to greater giving and put it in there.
Yeah, it doesn't seem right. But,
no, they'll figure that out.
Yeah.
All right, so sounds like that's got a lot of potential. That's pretty cool. Let's pivot over a little bit to real estate again. So there looks like there is quite the proposed improvements or upcoming improvements with the low-income housing tax credit. You kind of want to walk through what that's looking like, because low-income housing and affordable housing is a major issue just across the economy, with the cost of living, the cost of building, the cost of owning. So kind of talk a little bit about that, and do you think that's going to help with that a little bit?
Yeah, so another incentive to give back to the areas, like I said, where maybe the neighborhood has fallen behind the development and the growth. So low income housing tax credit is a way for investors to go and put money into these areas that need affordable housing. There's a supply shortage, and the government subsidizes that by giving a tax credit. This has been extended, and it's going to be a permanent fixture of the tax code. Some pretty nice benefits. I think it's like up to a 30% tax on a number that they have you calculate out. It's really strengthens the investment option for somebody that's looking to get into these. I think when y'all talked about them on your last podcast, you were kind of wondering what it is all about. They have Section 8 is the housing law where you get into Section 8 housing. It's kind of governed compliance, and they subsidize rents for people. They subsidize your building of the qualified property and all of that. It's kind of a cool little piece that they're including in the bill there.
Switching gears here, just we can switch back whenever you want, but I'm going to throw it in reverse for a quick second. So most people, Caden, say they don't own any real estate. They have a W-2 job. They make $85,000 a year, let's say. They got a house, a car, a couple kids. Like, Let's be real with the people. They can just file their taxes on TurboTax. Is that accurate to say?
Yeah. Yeah, I mean, TurboTax is going to make you feel really good, like they're doing a lot of work for you, but they're just making you watch a wheel turning around for 5 minutes.
So I agree with that. When I didn't own any real estate, didn't have businesses, like that I could do it pretty easily. But as someone does a couple flips or starts to acquire a couple rentals, it kind of makes sense to have somebody in your corner like you guys or a different company that knows this type of stuff like the back of their hand, so they can get you these benefits. Because though the law has passed, you have to be able to know how to utilize this in order to see the benefits in a lot of ways. So I don't know if there's a number of rentals where you think it makes sense for someone to have a true CPA, or is it just one, or is it five? I want to hear your thoughts on that, Caden.
Yeah. I think it's relative to the individual a little bit. Um, some people are going to naturally be able to handle a little bit more complexity than others. I think if if the feeling that you get when you are filing is I don't know what's going on and you don't know if you're doing it right, you probably should be working with a professional. The scope of your service with that professional might change, where you may just need, some simple tax preparation. As you start building up and growing that rental portfolio, what you don't know about the tax code is going to cost you really significantly. And you're going to probably overpay taxes as you start scaling up as an entrepreneur, as a landlord. And at that point, the cost of not having that CPA in your corner is greater to you than what you need to pay them to have them on your team.
Yeah, no doubt. Like I think we felt that absolutely, and I think the first year we hired you guys, you found like a $270,000 deduction with our storage facility that blew down. I don't know if you remember that, Caden, at all, but that was like not a loophole. You just using the tax code, and it was amazing. And we're like, all right, we should have done this a long freaking time ago. It's crazy.
Yeah, I remember you guys had some storms that took over one of your properties and
We did.
needed some help kind of dealing with that. And we took that as a casualty loss, got you guys some money back in your pocket from that.
Yeah.
So good.
That was great because we messed up the insurance on that, didn't we, Sam?
Lucas did. Yep. Anyways, moving on from that. So what do you think? And I don't know if you have an exact thing or just a couple things that Lucas and I. So our business. You've been in our books. We meet regularly. You're very in tune with our finances. What do you think are some of the things out of this bill? Because you're not paying you for this time. It's free because you're on the podcast. What are some of the things that you think Lucas and I will benefit most from? And it could be something you've already mentioned, but just kind of curious, somebody that is doing what we're doing. What are some of the things that you want to emphasize that you think will benefit us most that maybe weren't there?
Yeah, so I think the opportunity for you guys obviously have, the $50 million portfolio where you're continually buying assets and improving the assets. For you guys, bonus depreciation is going to be a huge thing where you get to take advantage of that. And for now, it's permanent. So there's not a sunset on it written into the law today. I say for now because all it takes is somebody making a new law and amending this, right? So we've got a window of opportunity that's undefined right now. You guys are going to be able to do that. I think being more focused is Section 179 expensing. So sometimes bonus depreciation is the best way to go about getting the deductions, and this alter ego Section 179 expensing gives you more control over how much of the asset you write off, where bonus is more of an all or nothing shotgun. This is more of like the rifle. Did you get an accurate write off? So that's going to make a big difference for you guys. Section 179 is typically more effective for mitigating your federal and your state tax liability. So that's something that we can look at. I don't remember you guys having to pay any federal tax, but maybe you got hit a little bit on the state in the past. That's a big thing. Um, I mean, for you guys, obviously you're trying to take your wealth to the next level. So I think we need to be really dialed in on opportunity zones, looking at exiting assets to roll those into new assets where you can have a tax-free exit in 10 years. That's going to dramatically accelerate your wealth building over this next decade.
I love that. Go ahead.
Yeah. No, I like it. I think that's awesome. I think this just we're already going down the path, and I think just understanding the bill and having you guys on our team will just allow us to kind of just slightly change course. We're not going to go into the restaurant business. I fucking hope not, Lucas. But
That ain't the business we're going in.
but as far as just being able to tweak things, I think it's important to just always keep an eye on it.
Yeah. We're here at Caden and with our community, obviously we're always trying to keep a pulse on the market. We can't control it by any means, obviously, but we can react to it, whether it's seasonality or some other bigger cycles that are going on. But in general, I think this bill will have a positive effect on real estate, I would say, and I would just like to get your thoughts on that as well.
How it'll affect like residential and maybe investing real estate.
Yeah, so I have an interesting take on this. This is something that Marcus is my business partner at Beck. For those of you who don't know him, we were chatting about this, and really because of the big benefits that the bill has with the depreciation and being able to mitigate taxes, we really think that lower scale single family homes are going to start getting swept up. You already see big players like is it Blackstone or BlackRock? I can't remember the name.
Blackstone does the residential. Yep.
Yeah, they're already buying up in masses. I think you see a lot of people that are trying to have big portfolio exits, and they're even kind of bundling up portfolios to sell to those bigger players. I think that the housing crisis for those 300,000 and less homes is going to continue to, supply is going to continue to be going away, and you're going to see more of that being held as rental assets. As soon as it becomes a rental, it typically doesn't revert back to, an owner primary residence. So I kind of feel like there's going to be an interesting situation with supply for those lower end homes.
So how do we fix affordability then? You see interest rates going anywhere anytime soon, Caden?
Ooh, if I had a crystal ball, and I don't, I still wouldn't know what's happening with interest rates. Especially with the homes, even like the Fed doesn't really control those. They might adjust it down, but we might not see the market catch up to adjustments for 6 months to a year in reality. So I couldn't say that I know.
Yeah, so he's just alluding to the Fed's funds rate doesn't necessarily correlate directly to the 30-year residential mortgage. So the Fed could drop the Fed funds rate a point or half a point, and I think it would affect the residential, but it might not directly and won't overnight. So is that kind of what you're alluding to?
Yeah. And then, if we take a step back and kind of look at the economy as a whole, how much is available to borrow is going to really be a factor of how comfortable people are with the economy. When there's uncertainty in the economy, people are kind of holding on to their money and don't want to be exposed to the volatility. And this year we've definitely seen some volatility with the tariff wars. That quarter one was kind of all about the tariff wars. We've seen the anticipation of this tax bill over quarter two. I'm kind of interested to see what happens with the economic and political climate that we're in.
Yeah, you think things will settle down or get a little more, people could get a little more sure in the second half of this year? Because you're right, the first part of the year was definitely a lot of volatility, a lot of shakeup. And then, I don't know if people are just going to get used to it or things are actually going to settle down maybe in the second half of the year. I don't know. What are your thoughts on that?
Yeah, well, of course, my focus is primarily on like this tax bill and everything. And I feel like the bill kind of introduces a lot of opportunity and maybe even some focus. People are going to be going and trying to acquire homes to do bonus depreciation. Folks might be looking at opportunity zones and getting their money into those funds to start investing in those areas. So maybe it provides some focus because of the incentives, and maybe the foundation really gets shored up that way.
Yep. No, that makes sense. So, what is there anything in the bill that you don't like, that you think, like, oh, that doesn't make sense, or just not your favorite part of the bill? Because we talked about all the positives of it, and some of them are unknown, some of them are pretty known, the positives. So let's kind of flip the script. What in the bill do you not like, if anything?
Yeah, that's a really great question, to be honest, guys. We actually did a case study. We did a case study that's called A Big Beautiful Mess. We presented this on a webinar that Marcus and I hosted last Friday, and actually showed people how one of our clients that we work with, his situation in 2024 where he's paying no taxes results in him paying just under $250,000 in the new Big Beautiful Bill.
That better not be us.
It's not you. It's not you. I promise. Hey, you guys mind joining me for a call after this? No.
Yeah, there you go.
There's two things in the bill that are kind of tricky and almost going to be hidden to people who don't understand it. It's the excess business loss limitation, and then there's a limitation on itemized deductions. So we talk about most people use the standard deduction. Just off the bat, that's going to tell you that this doesn't apply to the masses. This is going to apply to a very specific group of people. You take people who have high income. So, in your world, some of the listeners might be real estate entrepreneurs, and their spouse might be a doctor or a lawyer, or somebody that's got a high W-2, right? So if you've got a high W-2, let's say over, a $500,000 W-2, you're going to struggle to offset, your non-business income, which is going to be wages, interest, dividends, capital gains, retirement incomes. All of those are non-business. The excess business loss limitation says you can only offset a certain amount of that non-business income with business losses. So depreciation can offset all your business income, but it can't touch over $626,000 of non-business income for a married couple, or $313,000 for a single person. Well, why does that really matter? For this particular person, they had $1.5 million of non-business income. So 626 out of that leaves them with like $854,000 is the numbers, right? Well, then there's this itemized deduction cap that got put in place on the new bill, where they were able to go and do charitable strategies to donate assets and get large charitable deductions to wipe out their income before. This year, there's a cap on how much itemized deductions, including those charity deductions, they're able to take. So, last year they had a negative taxable income. It was like a negative 115. This year, their itemized deductions are capped at 164. So you take 854 minus 164, you're left with a nice chunk of taxable income. That's that $216,000 of tax that they're going to have to pay if we don't do anything different this year. That's kind of a trap for high income earners. And maybe people don't see that, but some people are going to pay more taxes because of this bill.
Yeah, I think that was beautiful, Katie. That made a lot of sense. It was a big, beautiful bill you said there. But I think most of our listeners and the people that we help, we're kind of around the median income.
I'd say 75 to 150 grand.
Yeah,
like that,
they're right there, and we try to help them, create freedom in their lives and kind of start to increase their active income as well as their wealth. That's and we do that through real estate. But there is a majority. That's not a majority. Definitely not a majority. But there's a portion of our country that makes really good money and just doesn't know what to do with it. I know that sounds like not a problem, but to these guys it is, and we're kind of dipping our toe into helping out some of these high income earners, and I think some of that stuff that you said there, Caden, is going to be very beneficial to them as they learn how real estate can help and how much it can help in some of the different strategies that that are out there for them.
Yeah, absolutely. Yeah, and I think other than that, the bill overall I think is helpful to everybody. You get lower taxes by default with the brackets and the standard deduction. You get a lot of flexibility with the opportunity zone. You get flexibility with the manufacturing opportunity that they wrote into there. There's a lot of different things that they do want. So maybe if you're in that situation where the high income is your scenario, you might want to go and look at some of the incentives that they have that you could take advantage of that are not being limited, because that's kind of where they want to take your attention.
That makes sense. All right, probably a couple more. Is there anything that's not in the bill that you kind of wish were? I just have this image in my head of you, super smart CPAs, just talking about the rumors of the bill and what's going to happen, just like we would talk about, something that interests us. So, is there anything, and there might not be, that you're like, I thought that was going to be in that, or rumor was that was going to be in it, and it's not, that it doesn't have to be good or bad, that just kind of took you by surprise that it wasn't in there, or maybe they got taken out?
Yeah. So the the things that I kind of thought were going to be in there mostly were. I knew that bonus depreciation was going to be a big thing. I knew that they were looking at basically just extending the benefits of the first, Trump 1.0 tax bill from 2017. I think if I was going to say anything was missing, is maybe a little bit of common sense in some things. One of the deductions we didn't talk about at all is like you can have the interest on your vehicle. This is like a personal vehicle. You can deduct the interest on your personal vehicle as a deduction, and it's for low income people. It's just kind of a little dumb to me that they're going to go and incentivize bad debt for people who probably shouldn't afford it, even if they can. You know what I mean? I would have expected to see, if they wanted to really help people, something similar to like a tax credit for electric vehicles for folks buying American-made, vehicles. Maybe they give them a tax credit that actually helps them and puts money towards the problem instead of incentivizing bad debt.
You haven't heard about Trump and Musk? There's no more EVs, so that's Trump. No more EV tax credit. Trump and Musk got a little tiff the other day. If you didn't hear about that, so
Yeah, saw that for sure.
cool. Well, what would you? My last question, and leave it on Luke so we can wrap up. What would you rate the bill on a scale of 1 to 10? Just cadence, Mister Beck. What would you give it out of a 10?
Yeah, I think largely it's going to help a lot of people. It got a lot of opportunity. I'd probably say like an 8 or 9 out of 10.
Nice. I like it.
On the tax side, for sure, right? Because this bill wasn't just taxes.
Correct.
Right?
But that's our angle on it, and
Yeah.
it's a big part of it.
Yep, for sure. Well, that's all I got. I don't have anything you want to leave the people with, Caden, either about the bill, and then maybe tell them a little bit more about you guys and where they can find you and how they should reach out.
Yeah, for sure. So one, I do want to maybe drop a little nugget for people. Right now, committees in Congress are working on a correctional bill. They felt rushed passing the bill that got signed into law. So over the next month or so, I'm actually expecting to see revisions and changes to pieces of the bill. Some of that might change what we talked about here today. Some things may be different. So I would pay attention to that here over the next month or two. If you've got investments, that you maybe have 1 or 2 rental properties or 5 rental properties or 10 rental properties, you're building a business, I think it makes a lot of sense to reach out and build a relationship with a CPA who can help you make better decisions. Now is the time to take control of your tax liability for 2025, not in December or April next year. Today, you can make a plan to do stuff to change it, is maybe what I'm getting at. And if it makes sense and you want to talk to us at my firm, you can go to cfo.com and click on free consultation to get set up with someone from our team and see if we're a good fit for you.
So 2 C's back to back, BEC, CFO. Go there, check it out. They do an amazing job on our tax liability and tax planning, and we're couldn't say more good things about them.
Yeah, we're lucky to have him. Thank you so much, Mr. Caden Hackney. Appreciate you coming on and giving these guys the knowledge about the big beautiful bill that they deserve.
It just built on what the foundation that we laid, but you did a good job.
You're welcome, Caden.
Yes.
You're welcome.
Oh yeah, I'm standing on the shoulders of giants, guys. Thank you.
Yeah.
There you go. All right, awesome, man. Appreciate it.
All right, see you guys.